Good NFP day, everybody. Mike, Laura, Richard, AJ. How's everyone doing?
Good early morning, Dale.
Hey, buddy, how are you?
Very good. It's going to be a beautiful morning. It's going to be a beautiful day.
All right, I like the attitude. So we all need to have hope. Just don't use it in your trading. Got to be positive about what's happening here. And I just have a comment about euro. And it doesn't guarantee anything, but, you know, we've made two successive new highs in the dollar index this week, right? We did it on Monday up here, and then we did it yesterday. And I just want everyone to search their memory and try and remember the last time the Dixie made new highs without euro making new lows. Okay. Normally, when was the last time, Ryan?
Can we cheat and look at
Yeah,
a weekly
go ahead.
chart?
Yeah. So compare the. I think it's been a long time. I mean, not that I have a great long-term memory. I just think it's a little unusual. It's not what has been going on for most of the bull market in the dollar. So
actually, you're a bit of a sponge when it comes to your long-term memory. So I don't bet against Dale's memory.
All right. Well, anyway, I mean, can you remember, Blake? I mean, you know, it's just something I thought about this morning. You know, we tried to, you know, we almost did it yesterday with that big surge in the dollar, but still hasn't. I mean, we get a strong employment number, of course, you know, that could happen. But
well, I'm sorry, I didn't catch the question earlier on what you were thinking.
Oh, when's the last time you've seen the dollar index make two successive new highs without the euro making a new low?
Yeah, gosh, I don't know. I don't know.
I don't either.
You know what I would think it would be, and just I'm sorry to interrupt there, Ryan. You might have been. We're maybe going to say something. I would have thought, if I had to guess, it was probably be sometime during the European crisis, when Greece was really, you know, struggling, and I think it was Greece and Italy and Portugal. A lot of the the periphery. I think there was at some point towards the end of that crisis where you know, the dollar kept making new highs and the euro kind of diverged away, and that's when you kind of went, oh well, it's not dropping anymore on bad news, and then we reversed. But I don't know, I'm guessing it, just thinking off the top of my head.
Yeah, I say, you know, just something I noticed. I'm not saying it's actionable. I would just put it in my calculator if I'm real bearish the euro, that it's showing some signs of diverging from dollar strength. You know, if the dollar's going to 110, 111, I think that, you know, we'll see 99 again. And then the other thing I just have for Stel, and you guys know on my miners, I'm, you know, taking, you know, I have a pretty big drawdown on my miners position, but I drew this wedge in silver before we, you know, took it out, and had a throw over or a throw under. But silver, and kind of like the euro, at the last low in silver, which should have tempered my constructiveness, we confirmed it. And this time we're not. Similar to what happened in the euro on the daily low, even better construction. We confirmed the low back here. We didn't confirm this low. So just something I wanted to point out. And also, this is a nice little wedge. So if we get back inside of it, and then we close, say, back over 18 and a half, you know, if you're looking for wedges, that the rule is from Edwards and McGee, Blake, that it can retrace 100% of the move. So just something else to put in your wheelhouse.
Dale.
Besides,
Hey, sorry to interrupt.
Yeah.
One thing I want to say about silver. I think the next support, realistically, unless we get a big turnaround from the Fed or data starts really getting bad, is somewhere
16.
between 15.5 and 16.5, somewhere there.
Okay.
Now, I had a conversation with a friend of mine this morning, and he was saying, you know, what's happening with this? He said, look, treasuries are falling, so yields rising, so people will sell gold and silver to buy treasuries because they yield something, and you know, gold and silver don't yield anything. And I'm like, okay, so if you have some money that you want to invest, all else being equal, supply and demand being equal, okay, and I think we can argue that demand for silver is rising massively because you're seeing physical being depleted everywhere, COMEX everywhere. You go to buy some in the shop. I went, and the premiums are ridiculous.
Yeah,
So
I had to pay
like 100.
yeah, I had to pay I don't know, for Buffalo rounds like 250 over spot.
Yeah,
Which
oh, that's
wasn't
good
bad.
actually. I couldn't
Yeah.
get anywhere near that. Anyway,
Okay.
but I guess this is Greece. But so I'm saying, okay, supply and demand being equal, would you rather have something that will give you 3%, or when inflation is bringing everything higher, everything, right? Every good, every service, everything is going higher. You think this is going to be a reason for silver to go lower? It makes no sense when every commodity has done 100%, 200%, whatever. It makes no sense for silver to be here. But I said to him, I would hold off just a little bit more because the market is irrational and it will remain irrational until something flips. And we haven't
the market's always right.
The market's right. Yeah. I mean, momentarily
irrational
it's right.
or rational, it's
Yes.
right.
Going to take a turn in the dollar regardless of what yields are doing. But you know what? I want
agree with that.
Yes.
kudos to you, Stel, because you know, all this time I thought that we were gonna, you know, this was gonna be a failing rally and we'd head lower, and you were spot on about higher rates. Also, when Grega was on earlier in the week, he was negative the notes, looking for new lows, and I thought we might put in a right shoulder. That doesn't look like that's happening. So good call on rates.
Well, yeah, I get lucky sometimes. But what I was going to say is that we're going to be talking here on F.A.C.E when silver goes to $50. We're going to be talking about it, and we're going to say, oh, remember what we were talking about? Well, things turn, and there are cycles, and given the expansion of money supply, there's no reason for silver and other commodities to be down here. So they will turn, but just don't be too early. Having said that, the way I trade is I get in unleveraged, and I don't mind waiting 2, 3, 5 years for something to perform. Like I've repeated this so many times. 2018, I got in at, what was it, 15-ish, 15 and a half, something like that on average. I got a big drawdown during COVID. I didn't care. I should have added, but I didn't. And then at 25, we're out. And so over 2 years, that's a pretty good annual return. So if you're not, you know, for me, I'm not worried about being down 5, 10, 20% on something because I believe in the trade. I'm not leveraged. And eventually, I know, you know, fundamentals tell me it's going to work out. So I'm waiting. I'm going to get in. If I'm early, I'm early. I don't care. But anyway, I don't suggest others do this, but that's just what I'm doing. Anyway.
Okay, I think most people will be late. I was early. That's why I went with miners.
And our friend Paul correctly says it's needed for electric vehicles, for solar panels, everything, that's the new forms of energy, new technology. It's needed everywhere. So there's absolutely no reason for it to be there, apart from the short term. I want to call it panic, call it whatever you want. Oh my God, the Fed is hiking, yields are going higher. It doesn't matter. Short term, it does. Medium term, it doesn't matter. Anyway,
3% are still negative rates.
Yes.
So, Kman, what are you thinking going into NFP? Ryan, what are you thinking going into NFP?
Well, in the way that the market is trading now, and we only have to look at the dollar yen. Is the market is still buying dollars? Rates are high. It's going to take a bad number to stop this dollar yen. That's for one. It's going to take more than a bad number. I think it's going to take an unemployment rate that's starting to rise to turn this ship around in dollar yen. The market is quite firmly on the bandwagon of yen to weaken, and Bank of Japan has given us the green light as well. So I think that we're going to find dollar yen dip buyers if the number does not disappoint too much. For the euro, though, we may have to wait until ECB to decide whether the battle for parity is won or lost. To me, it's still 99, the level that has to break, but we may have to wait for NFPs, for the ECB, sorry. And so for today, I think that if we get a good number, we may see the rest of the dollar rally, the euro dollar come off, but I'm not sure that we are ready yet to break 99. That could be music for next.
Okay. So basically, you don't know.
Well, I mean, I'm a bit long dollars. I'm long dollar Norway. I'm long dollar China.
Okay. Yeah, you're bullish a dollar, but the euro, you don't know.
Well, the euro, we may have to wait. I mean,
yeah, okay, that's valid. Yeah, I don't know what to do. I'm going to wait and see what type of action I get. Wait for a breakdown or wait for it to prove itself. What would make you turn more constructive on the euro?
There's one thing that is happening right now is that the European gas prices are coming back down. The natural gas has come off like more than 30% since last week.
Yeah, how did that happen? I noticed that. What, electricity prices too. Yeah, I mean, is it really Russia, or is there some manipulation going on by utility companies?
Some manipulation, but the manipulation was both sides. I think if you take example of these Dutch TTF, the gas prices in Europe, they went from what 30-40 euros up to 340. I mean, okay, you can panic and make Europe pay for the building up its reserves. But then I think as well, the fact that the European reserves are now built up to 80% of and where they should have been right now. So maybe the market is going like, oh, okay, maybe it's not completely panicking and we need to take a bit of profit. But for the time being, with all the weight still around Europe's neck, I still can't buy really euros.
It's hard. Yeah,
there's only 1 euro I can buy is euro yen somewhere.
Okay. But, all right, I understand. Yeah. I mean, the background, I can't think of one fundamental reason except for maybe, the ECB that, beginning to outpace us, but I don't know. Yeah. I wanted to ask Blake, here we are, Blake. I had this dotted line drawn and we're at 78.6 in euro. And if you want to still call it maybe a head and shoulders, left shoulders over here, right shoulder here.
It's a really tough call, and actually I'm looking not only at the Aussie, I'm looking at the Kiwi as well, and the Kiwi's holding some pretty critical support. Here I'll take over the charts from here, but okay, really quick. Okay.
Oh no, I lost control.
You have completely lost control. As long as your bladder is okay, Dale, then we're good. Well,
I'm a spokesperson for Pampers.
I know it's not funny as we get older. I know. All right, so let's take a look at the Kiwi here, and you'll notice that 60.50 level really held. That was the low from today, but that's pretty critical low there. And going back to the Aussie, this could be, that inverted head and shoulder pattern. I look at it like, okay, well, if it is a complex, which it could definitely be, that's when you have your head, your neckline, which is more of a slant, descending, neckline like that. Then you would take the shoulders here, look like this, but then you would say, well, that's just a channel. You know what I mean? I don't know if I can really argue too much that that's the head and shoulder pattern. We really got a hold here. This is the 78% retracement, but I'm not convinced. I know a lot of people think that employment is peaked, and I've heard some stats over the last couple of days about like the August is typically a very tough month for U.S. payrolls, and seasonally, we could see a miss. And if that's the case, maybe the dollar does weaken. but I'm still not in the camp that employment has peaked yet. And, so therefore I have a really difficult time trying to fade the dollar at this moment. And that's not just because I'm long dollar yen. I mean, if you were here yesterday and obviously in the ForexAnalytix, chat rooms and stuff, that I'm long dollar yen on this breakout. I'm actually targeting, much higher prices. And I have a hard time, trying to lean into selling this right now, knowing, that we're going into the jobs data. How many people are trying to position themselves on the on the opposite side of this data today? But it's going to be a pretty binary event, as far as release goes. We have bad data is going to weaken the dollar and strengthen the stock market, and good data is just going to continue to keep pressure on the stock market and upside pressure on the dollar. And I would think anything, the market's looking for 300,000 jobs. I would say anything above 200,000 jobs, the market's going to just look at that as being strong. You guys have any opinions on that? Ryan, Kman, Stelio, Steve, if he's here.
He's not here. I think he's traveling. I agree. I think that even a relatively small miss will be the Fed will take it in its stride and just keep going.
I would buy a dollar dip in that. Like if you get, let's say we create 200,000 jobs, and obviously there's other data to look at, and maybe Ryan or Kman can help us dig into the data. But just talking about the headline data, if we have a number that's 200,000 and I see a real quick dip, like let's say the US dollar to Norwegian krona, which has a nice inverted head and shoulder pattern, we get a dip like this today, I'll buy it. You know what I mean? I'll gladly, pay for a dip in the dollar. You get a dollar yen that gets a dip now. I mean, we're moving so far away from the 140 level. You get a dip below 140 and you're going to find buyers now. I mean, you got to think about people that are on the other side of the trade. How many people are fading the yen right now? I saw something on like IG's positioning, like their retail positioning. The majority of their retail traders are short dollar yen right now, and they're long stocks. So I mean,
it was a nice recovery in S&Ps, and I think it went to Greg's number. He was talking about 39.20, and actually 39.02 was 61.8 back, right?
Yeah, the 3900 was the 618. If you guys are ForexAnalytix subscribers, we've been red hot on identifying this 3900, and we bounced off it like a bat out of hell yesterday. It was a really big rejection. So yeah, we hit it, but how many people right now are long equities and short dollar yen? I mean, it's just the retail market's leaning into it, and you guys know that retail typically is not right.
We're retail.
So as far as that goes, I just I think you have to buy dips in the dollar with the data, as long as it's not a horrible piece of data. It could be. I hear everybody talking about it. I know what everybody's saying, and so let me ask Ryan. We have you're running a poll right now, aren't you?
Competition. We're running the non-farm payrolls competition. I'll put the link.
Can you grab a link to that?
Put it out
and put it in the chat box.
Done it.
Oh, it's there. Oh, you just put it there. Yeah. Hey guys, okay, so check this out. This is the link. It's in the chat box to everybody. If you want to try to win a free month, right? Is that what it is, Ryan?
Yeah, a free month. 3 people can win a free month.
Okay.
A free date with Blake.
I'm gonna give a date to Steve. I'm gonna pass that off to Steve.
Hang on,
if you guys want to talk economics with Steve for an hour, there you go. Let's see. I'm gonna put in my guess.
If you're an insomniac,
my guess is 333,000.
Wow.
Boom. There. That's my guess. So I'm going to try to win a free month of ForexAnalytix. But you guys want a free month? Jump in here and jump.
A lot of risk on this contest here.
Yeah, I better tweet that sucker out.
Bragging rights at ForexAnalytix, Dale.
Oh my God, I was wrong on the NFP poll. How depressing. Anyway, okay.
Get your number in there, Dale. Get your number on. You know you want to have a go.
Oh, okay. I want to do it. Okay.
I personally think for the market to really kind of worry about these numbers, they have to be double digits, and I don't see that happening.
Yeah, it's an interesting question there from Chris. If NFP has a mixed print, which will matter more, jobs, unemployment rate, or wages? That is important how you read these numbers. Always go with the headline first. That brings you initial reaction. Then you look at the unemployment rate, but you need to look at the participation rate alongside of that, because it can have a big pull on what the unemployment rate does. If the unemployment rate rises, but that's because the participation rate has gone up, it's not necessarily a bad thing. A perfect world, if you want a good unemployment rate, you want the unemployment rate to come down while the participation rate goes up. Following that, look at wages. Is there a big move higher or lower? Because obviously that feeds into the Fed's inflation thinking. So it's headlines, unemployment rate, participation rate, wages.
All right, thank you for that breakdown. That's pretty awesome. Kman, what are your thoughts here going into the data? How are you going? First of all, what do you see as far as the data goes, and what are you going to be looking to trade?
Well, and as I've said already, I think there's a couple of things on my radar. So it's dollar yen for a starter. And then dollar Norway, dollar China. I think if the number comes out, let's say good, which is anything over 200K, in my opinion.
Oh, okay.
Yeah, I think dollar is just going to continue to go higher. If we get a really bad number with a higher unemployment rate, then we can get into Dale territory and see the euro dollar jump.
How about playing that Aussie on the long side? I mean, the Aussie, the Kiwi's got a really defined.
Aussie is on a pretty great level, right around this 67, 60, 80 zone. I have marked it. That's an interesting zone for me. That is one. Kiwi, I'm less convinced that it's going to follow the rest a lot, but it's going to be a dollar trade. No, but the ones I'm really interested in is actually the NOK, because with with the Norges Bank pouring in, with oil lower, I think that's a good dollar long if the unemployment report beats.
I don't know if we lost him, but I agree with that. And I want to say that if you're going to trade the Aussie, keep in mind that the RBA is Monday here in the US, and it's going to be late for you guys and gals in Europe, and because it is Tuesday morning in Australia, the RBA rate decision. Did we lose Kman, or was that just me?
No. I stopped talking. But can I just add one thing? QT doubles in the US, so that's going to be important going forward, because if people want to do their refunding at these kind of rates or even higher rates, it's going to have a tightening effect on financial conditions. So if this report comes out good and the yields shoot higher, with the QT starting to double, there may be a fly off the top of the dollar, I think.
So how somebody explain this to me, and maybe Ryan, you can understand this, or you can help explain it to me. As rates go higher, how are we supposed to fund our deficits when rates continue to race higher? And that's just not for us, for everybody. What do you guys think?
It becomes a bit difficult. It puts the fiscal pressure on. I mean, you look at the Eurozone and all the debt they issued and everything that went on during the GFC and all that. It puts the pressure on borrowing. But obviously that gets passed along. Then they look at higher taxes. It becomes a very difficult situation, because if economies are going backwards, you're getting into the real stagflation fears, which something that we're potentially entering in now. It does become a big issue. And then, as Kay's been mentioning a lot, you start getting the dollar funding issue calls coming about.
Yeah, that's where the dollars all have to come home, and everybody needs to finance with dollars. And a lot of people don't understand the fact that the dollar could really come out of its shoes here. I mean, if rates continue to go higher, we could actually see I started looking at the dollar index and imagining like why or what could be the driver that takes us beyond this channel resistance, and not this channel, guys. I mean, this is the dollar index. That's a pennant. It already points to the top of this channel. But do you know the top of that channel, the black one? That's a weekly channel that's been around since 2012, 2009, since the GFC. So, I mean, I start going, okay, what's going to put us above 113 towards 120 in the dollar index? And that's exactly what you're talking about, Ryan.
Yeah, but it's also not, and I've been speaking about this last couple of days, you forget about whether the Fed hikes 25, 50, 75. That's not what we're trading now. What we're trading now is how high the Fed might go on rates. And that the market doesn't know. And I don't think the Fed knows either. But that's what we're trading now. So, we will get noise if they go from 75 to 50 or whatever, but it's how high they're going to go. And no one knows where that is. And in that scenario, like you say, add it all together. If they keep going, dollar's going through the roof.
Man, it's a scary thought. What are the knock-on effects, Dale? I mean, what are we going to see?
I think what you were talking about before, servicing the debt, just the interest costs on the debt. And that's why guys like Luke Groman and others say that if the Fed continues on this course, we have a sovereign debt crisis, first one in 100 years.
Why won't they just print some more money and borrow more? I mean, there's a deficit of $1 trillion every year. Make it $1.3 trillion or whatever, and pay off the debt, pay off for higher interest. I mean, what's to stop them doing that? It's just going to devalue the currency a little bit, which is really strong anyway. Yeah, I don't think the US will ever default, right? I mean, they're never going to default.
No way.
No. Why would we?
Yeah. No, absolutely. They're never going to default.
Yeah. Yeah. As big of a Ponzi scheme as it is, it's funny because people go, oh my God, it's like how can that happen? It's like, dude, it's the game. Don't hate the game, hate the player. It's like, it's the world we live in, guys.
Exactly.
Gals. I mean, exactly. It's like, you can argue it all you want. It's like, I laugh at people that, just like, oh, the stock market's so manipulated. I'm like, well, don't play.
This is what we have. Exactly.
Go somewhere else, buddy. Whatever you want. But it is the global economy. Yes, I understand that. It is the world we live in. I do understand that. And I'm sure who's going to have something to say about this is Julian from M2 Partners, who you've got coming up, Dale. I'm excited. Yep. Julian's such a great guest to have here on a day like today, isn't he?
Yeah, any day.
Any day, yeah, for that matter, yeah. So anyway, you should ask him those questions.
Forex guest hunter.
That's right.
By the way, Mike says the USD is our currency and my problem. It's not my problem. Why is it my problem? I just traded. I don't know where you got that from. Anyway,
hey, if you guys have not watched this interview with Dale that I did of Dale, you guys should watch it. I'm going to put the link in there on Trader Summit for everybody to watch. You guys want to see, what Dale's all about. I think this is a really great interview. I had a lot of fun doing that with you, Dale.
Yeah, I did too, Blake. I thought about it afterwards, and it's, everyone could listen to it, but I think it'd be really valuable for people in their first couple years of their trading journey.
Yeah, I think so too. I really do. All right, I'm going to pull up. We got a minute before the data. What you're going to see here is you're going to see the dollar index, the S&P. I've got these on 15-minute charts, the S&P, and then I didn't want yields on here. Actually, you guys know where gold's at. Well, shoot, I kind of actually want to have gold on there because you guys know if we drop through 1680, there's a lot of stops down there. So I just want to keep that kind of on the radar. And if you go over to ForexAnalytix, pull up the data flash. This is how we're going to monitor the data. So here it comes, guys. The data is coming out in just a second. Watch all these numbers right through here. All right.
Do it.
No more bets. No more bets.
Wait, buy everything. No, I'm kidding.
10 seconds.
Let's see.
Negative.
Oh, that will be a big surprise. That will be a big surprise.
Market's looking for 290. There's a headline number here. You know, anything above
1 million.
315. So that's in line. Unemployment slightly higher, 0.2 higher. Participation also higher. So that's actually not too bad. Average early earnings 1.1% lower. So really not bad numbers. These are good numbers.
Well, how come my data didn't come out? That's weird. So what was the headline number?
315. So that's good numbers.
So
why is the market
dollar
rallying?
selling off?
Why isn't the dollar? The dollar is selling off.
Yeah. Why is it?
Why is it? That is interesting. I don't know. Maybe because
there must
everybody
be some weakness in maybe hourly wages. Is there anything you see, Ryan?
Just looking now, the unemployment rate is up 3.7, but it's due to the participation rate. Quite a big jump there in the participation rate.
Okay.
So it's not.
People ran out of money from what they got during COVID. They have to go back to work.
Yeah, which is one of the things we spoke about previously. You know, if people are forced back into the market, you know, you could see a situation where employment growth is still there, but the unemployment rate is rising because of the participation rate. That looks to be the case. I wouldn't call this a negative report. I think maybe the market's moving on that unemployment rate jumping just on a knee jerk. I don't think it's a bad report though.
Good call, Rio Mio. One of our attendees.
You know, it's I just picked up some dollar yen down here. I'm sorry, guys.
I just updated the chat room. I've done exactly the same.
Oh yeah, I mean, you know, it's like that's a good. I like the data. So
Silver's back
that dipped to
that
140,
throw.
and the dollar yen was that was a little gift for you guys. If you missed
that was a low in gold yesterday too.
Yeah, look and watch gold here. We spiked up to 7. Watch we go. We're going to go negative in gold here just in a moment. But yeah, if you guys didn't pick up that dip and the dollar yen down at 140, I mean, you guys, you know, I mean, that's you got to be buying dips on that type of data. And even if you just scalp out of it for a quick 30, 25, 30 pips, that's fine. Interesting. It was an interesting response today, like that initial, you know, knee-jerk reaction, stocks moving higher, dollar weakening, but it's going to be interesting to see if the dollar is going to be, or excuse me, if stocks are going to sustain gains today.
Just keep in mind that people are very long the dollar, people are very short the euro. So if this action continues, they can be squeezed.
They can, but remember, we got the ECB next week, and let's not forget that the euro is just bouncing around between 101 and 99 cents. I mean, this is the range right now, and you got to be respectful of it. Just as yesterday, if you were in, you know, ForexAnalytix, we talked about how important that 99 cent level was. This is our bias chart that we do every day. If you didn't know that was really important support, then you know you probably weren't paying attention to this range that we're in. So just be respectful of it as we get towards 101. You know, I would probably be a seller because you do have the ECB, and I think it's going to be a tough winter for Europe. I don't know about you guys, but
let's move there.
Your guest Julian, I bet he's going to be able to talk all about it.
You jinxed it. You jinxed it. He's not here.
He's not.
Like, do you know what the really big news is?
What's that?
You might have come closest to the NFP number being 18K out.
Yoo-hoo!
Yay, Blake, you got a free month.
Winner, chicken dinner. Who else?
Are you gonna take that free month?
I'm gonna forfeit my winnings to whoever's the next closest.
Well, you haven't won yet. I haven't checked all the numbers, but 18K off is not bad at all.
No, Jean-François said 320.
He said 320.
Well, you better be on there, and I'll check the timestamps. Don't you worry about that.
All right, awesome.
No late sneaking on.
One of you guys,
check my email
we look forward to having you in the ForexAnalytix chat room at least for the next month. And once you get there, it's like you come to ForexAnalytix, you ain't leaving. because you're going to be like, man, I like this place. It's cool.
You can check out anytime you want, but you can never leave.
Yeah, it's a great line.
Yeah. Speaking of which, this is what our ForexAnalytix chat room looks like just from this morning, and it's Friday morning, and it's you can see that I got up an hour and a half ago. It's about right here. You can see how active the community is. Yeah, this is when Julian's I said good morning. And Julian's here?
Yeah.
Okay, cool. So yeah, we'll see one of you guys or gals at least in that chat room, but you don't have to just wait to be a winner of the contest. You can just come check it out. Also, before you guys leave, make sure you check out the Trader Funding Program. They are the sponsor of today's show. If you want to learn how to trade our money and not your own money, not risk your own money, just watch the 2-minute video at the very bottom, and it'll tell you all about the program. I want to thank everybody for being here today. I'm glad Julian's here because I'm sure he's got a lot of, Dale, you should ask him about the rates going higher, how that's going to affect the world. And then also, about the euro and how tough the Eurozone is going to have it going.
Why don't you just do the interview?
No, it's your interview, buddy. You asked all the good questions. I'm just giving you things to think about.
I'm kidding.
All right. Hey, everybody.
You can interview him on the other channel.
Well, maybe one of these days we will. But I want to say that, next week it's going to be a busy week as everybody's coming back in from vacations and holidays. So I'm excited to get trading. You guys all have a great one and enjoy your weekend.
Thank you, team, for laying it on the court for everyone. Ryan, Kman, Stel, Steve's not here. Blake, all you guys doing the best to help people out and guide them.
Thank you, Dale. Have a great weekend, everybody.
You too, Kman. I'll sing his song over the weekend. Okay, buddy?
Oh, yes.
All right. I'll do it my way. And Julian Brigden, welcome back to F.A.C.E. Were you busy trading the NFP? Julian, how are you? I'm asking you to unmute. Waiting to hear you, my trading warrior brother. You have to do something with your audio.
He is still muted, isn't he?
I mean, well, there you go.
There you go.
Can you hear me? Perfect. Sorry about that, guys. I could see the screen with all your prices and stuff, and I couldn't for the life of me see where I unmuted.
All right.
No, I mean, I think it's a bit of a nothing, that non-farm payroll, to be brutally honest. I mean, it was robust. We know the trend is for slowing data, right? There's definitely some signs on the margin that the Fed has managed to sort of soften this labor market growth. But I don't think it's enough. I mean, on balance, and you can see this in the market, people are like, oh, does this shift us from 50 to 75? I really give a shit?
I think 70, don't you think 75 is baked in after Moses came down from the mountain at Jackson Hole?
No, I mean, I think, look, 75 is, I think you've got to think of it like this. It's, from a policy perspective, right, you're trying to turn a super tanker, okay?
Yeah.
It really doesn't matter, Dale, whether you do 75 or 50 or even 25, right? We all get our knickers in a twist about this. We all get all so excited. Pivot.
So is QT more important, Julian?
No, I think ultimately where rates go is more important, right? So they can go 75, 50, 25, 25. They could go 50, 50, 50, 25. They don't give a shit. Right? 75 is kind of an emergency measure. 50 is the new 25, for want of a better term, but it's still, somewhat aggressive. But really what matters is where they're going and then what happens. And then to your point, I do think that QT is more important.
Okay.
I do think that QT is more important. So I think we're going to 375, maybe 4. Then I think they've made it very clear that their plan doesn't mean it actually pans out like this, Dale, right? That's how we make our money, is betting against these guys in many respects. But their plan is that rates sit there at what they would call mildly restrictive, okay, for an extended period of time, right? This is what the last few months have been all about. It's been pushing back against the assumptions of the bond market that we would see rates immediately get cut, okay?
Well, I think that was crazy, but you know, you're not going to go from tightening to cutting. You're going to go from tightening to standing.
Well, you could if you break the equity market, right? And I think ultimately that's what the bond market has been pricing. Okay.
Okay. So if it's all about the S&Ps.
Yeah, I mean, if you really put a gun to the bond market's head, right? If you look at, say, real yields or something like that, right? I mean, there is a massive divergence between what is priced into the market's view of real yields, which is tips basically, and actual real yields. If you look at, say, the 2-year differential. So if you want me to, can I share a screen on here, Dale?
Oh yeah, that'd be great. So I'll stop sharing and it's at the bottom of your screen, Julian.
Yep. Okay, hold on one second.
So how are you advising your subscribers to deploy capital in an environment like this? Where are they hiding?
Short stocks.
Just short, okay.
Yeah, I'm short at the moment.
Okay.
So, where's that go? Bloomberg, what the hell Bloomberg doing? Sorry, hold on one sec.
There, okay, I see a Bloomberg thing.
Yeah, it just threw a wobbler.
Is that a cricket term?
Yes.
We call them knuckleballs here in America.
Yeah, exactly. So, okay. Screen. Okay. So here you've got tips. Okay, this is kind of the market view on real yields, and here's actual real yields versus CPI. And remember, tips are calculated off this. So there is a 600 basis point differential between the two. Okay. Wow. I mean, typically, you know, you can see here between like in 2008 and then in 2011, it was in fairness this that corrected as CPI fell, right? But that's a hell of a correction in CPI you're factoring in over the next 2 years, right? 600 basis points. So the bond market is fully on side that the Fed's getting the target down to 2%. But you could ask yourself, how do you realistically get that? I mean, you know, does suddenly energy go massively negative? What else could happen? I think really what the bond market is telling you is they're kind of thinking the Fed is going to massively overcook this thing. They're going to break something. But what do they have to break? They have to break the equity market. And the problem there is it hasn't really broken yet, Dale. Right? And we're down. But we're not out, mate.
Do you have a level?
Close. Yeah, 3,000.
Okay,
on the
that
S&P.
would be it. Okay. All right, so that's right around the pre-COVID highs, 3,100 or so.
Yeah, something like that. Yeah.
And that would be your definition of a broken, that the Fed
will
finally
I think that would
nervous.
do enough to damage the economy, right? I think that would do enough to damage the economy, given what I refer to as hyper-financialization. Okay. In other words, this correlation between the real economy and the equity market, which is basically 1-for-1, where in a bizarre way, you would think that the real economy would lead the equity market as a deriver of, you know, profits and growth, et cetera, but it's actually the other way around because of the behavior of CEOs who are only paid to support the equity price. And so the minute the equity price starts to falter, they go and start cutting costs and employment. And we've seen that with all these tech firms, right?
Yeah, beginning to see it. So go ahead.
You basically have to get this equity market down. I think the Fed has to get this down. And today's number is just, I guess, is slightly welcome news. But 300,000 is still double trend, right?
Isn't it backward number?
Yeah,
or do you consider it pretty real time?
No, it's backward. It's backward.
Yeah.
right? But
so
some of the
Fed
real
be tightening
stuff,
into looking at backward indicators, and again, not looking forward to when Fed policy finally filters through
yeah,
the
sure,
economy?
but that's the nature of the beast, right? That's why their plan is to try and stop at 375 and 4, right? I mean, look, if they were real, if they were meaningful, if it's like, oh, we have to get rates above inflation, right, we'd be going at 8, right? Well, they're not, right?
Because we're still at negative rates.
Lags.
Yeah, because these are still negative rates, even at 3.5, 4.
I mean, look at this, it's 2 years, it's minus 500 basis points.
Yeah. So it's more jawboning than anything else, isn't it?
Well, I mean, I think it's, you know, they are trying to pursue what is, in central bank terms, referred to as opportunistic disinflation. Right? This is a policy that Greenspan followed in the mid-90s. We've never done it from this higher wire before, right? So it might not work, okay? But it's the only pleasant way to bring this thing, pleasant in inverted commas, to bring this thing to earth, okay? And that is, you raise your rates to whatever the number is, okay? You then leave them there, and policy essentially becomes asymmetric, whereby economic weakness and inflation weakness is not acknowledged, right? You don't cut, right? GDP comes in weak, inflation drops, you sit there for a long, long period of time.
Okay.
And you let growth and inflation comes to you, okay? Or the odds, and if inflation and growth don't, you hike aggressively again. So policy literally becomes asymmetric. And yeah, I mean, that's what they're hoping. You know, who's to say whether they can achieve it? I think a lot will have to do with the, you know, £1,000, gorilla in the room, and that's
the dollar.
QT.
So, QT. There's no sign of any shift in trend to a very crowded trade on the long side of the dollar?
I mean, I think positions are crowded. But I'm just, I'm writing a piece now for my clients for sort of Q4, and I'm just going through this European stuff, Dale.
Yeah.
I mean, it's dire.
Yeah.
Right? It's dire. I mean, I think, you could say there's a lot in the price. I mean, there's stuff in the price. I mean, but there's not a lot in the price. I mean, I think I was just reviewing some of the comments we got yesterday in the S&P Eurozone Composite PMI, right? And there were a couple of lines in there that comments from the chief economist, which I think were just chilling. I mean, the guy basically, I'm seeing if I can find it.
Well, there are people talking about there, actually could be starvation.
No, I mean, this is what he said, right? I mean, this is what I fear is coming slightly to the US as well. But he said, falling sales are not only increasing the number of factories to cutting production, but have also meant warehouses are filling with unsold stock to a degree unprecedented in the survey's 25-year history. Weak demand and the efforts to reduce high inventory levels are therefore combining to drive production lower in the month ahead, right? The orders to inventory ratio, an important indicator of future production, is in fact now signaling a downturn of intensity not seen since 2009, barring the initial pandemic lockdown months. So I think, we're looking at some of these PMIs. They look weak, okay, but they're not horrible in Europe. But I fear these are Wile E. Coyote. We're at a Wile E. Coyote moment.
On the ledge.
On the ledge, right? And this is going to look all right. We've got the setting sun of a nice summer in Europe. Packed. The place is packed. Okay, with American and foreign tourists because the exchange rate is ridiculously cheap. Yeah. Okay, but come October, November, unless you see consumer confidence bounce, which by the way is at 35-year lows in Europe, these numbers are just going to implode, and consumer confidence is going to lead business confidence, which is what it did in 2009 and the sovereign crisis of 2011 and 2012.
Okay,
and then,
so, yeah.
you know, then the euro, I think, does go. That's what I fear.
The euro is no more or collapses?
No, I mean, I think it drops to the
80?
bottom of the bottom of the channel. I mean, I don't have an FX position here because I think it's just everything's a little noisy, and my bigger focus has been on trading the equity market.
Okay.
But to me, unless you can get above, I mean, you're the far better chartist than me, but the one that I'm looking at.
See, I was looking for you to tell me if you could come up with any fundamental reason why the euro could rally. Can you think of anything, Julian?
Well, I mean, you are
can.
getting a tougher. I mean, there's some positioning elements. There are some positioning elements where the market's a little short.
Yeah,
the ECB
those are like
is
technical.
Yeah, the ECB is stepping up their game. 75 is the base case next week, right?
Yeah.
But I really struggle to come up with a fundamental reason, right? And it looks to me that technically, I mean, you're sharing your screen, but mine's actually, I think, if you let me share, I'll see. And I'd love to your input, right? You're the better technical guy. So if you stop sharing, let me share.
Okay.
Okay. This is what I've been watching, just to cut the noise out.
Okay. Yeah. All right. Pretty ugly. Yeah.
Yeah. I mean, you know, head and shoulders.
Yeah.
Neckline, unless you can get above 103.5.
I agree. That's when and that's when people will begin to embrace it. That was a big area, got rejected when it tried it a week or so ago. I agree. And then I also agree with your 109, 108.50 level. Should we get over 103.5, I think we get up to your red number.
Yeah.
That's my analysis.
But otherwise, barring that, I think we're heading kind of to these 2001, 2002.
The inceptions.
Lows, right?
Back to where it all started, full circle.
Back to where it all started.
Okay, so are there any particular sectors, or are you just doing indices, and any area in the world that looks more vulnerable as far as playing the short side of
in stocks? Yeah, I mean the one that I really think is potentially ugly is housing in the US.
Okay.
I think on a relative basis, I think people do not understand what's coming down the pipeline in terms of this housing slowdown.
Well, let me ask you this: the counter argument.
Yeah.
And you know, part of the rationalization, people then say, well, housing prices are going bananas because the Fed's buying MBSs out there, kazoo. The bull's argument was housing stock shortage. So how do we go, since you have to build them, how do we go from a housing stock shortage to a housing stock glut?
So, look, I mean, that's a valid structural argument. There's lots of people who'd like to buy a home, right?
Yeah.
But the desire to buy has nothing to do with the action to buy. Ultimately, the action to buy is one of affordability. And affordability is appalling. So you can sit there, you know, sitting in your mum's basement, desperately wanting to buy a home. But if you can't afford it, tough shit.
Yeah.
Right? Just tough shit.
And your mom's basement you're renting it at a pretty good price. Plus,
you're probably renting it a decent, and does your washing, right?
Yeah, I mean, you know, if my mom was still around, I'd think about it.
Yeah, exactly.
So let me ask you this: any fiat currencies that you like against a dollar?
Not here. Not at the moment. Not at the moment.
Aussie,
I think
nothing.
No, I think you can't. Look, Dale, I think we're going to get to a point where the rate of change of the dollar, and we're inching there, is historically associated with a crisis, right? I mean, it's actually very, very clear if you go back and you look at the history and you look at the rate of change, not the level so much actually, it is the rate of change of the dollar, where typically you get a crisis, right? Something breaks. Could be, we walk in one day and the equity market in the US has dropped another 20, 25%, right? And the Fed backs off. It could be that the euro drops to 80 and the ECB and the Bank of England are screaming at the Fed to do something, right?
Won't the Fed backstop Europe if there's a problem?
No, I mean, the ECB can backstop themselves, but the point is, there might be a point where it starts to cause systemic problems, and that's what you're looking for, right? You're looking at a rise in the dollar that causes a systemic crisis, and that's when it turns, because the Fed goes, oops, sorry, they back off, and that's when you buy everything that you and I have talked about wanting to buy
for the last year. I
mean, last few years, right? Ultimately, this is the end game. The problem is this time the pain threshold is going to be materially worse than we have seen at any point since the GFC, right?
Okay, so could it be an Italian bank or a banking crisis in Europe? How about China?
I mean, it could be. There's a bunch. It doesn't, it's typically a few things that go. I don't know exactly what the exact stress point is, right? I still, as I said, I mean, I look at the US equity market, it looks dire, to me, the setup. I mean, I think people are absolutely smoking crack if they think that Apple is a place to hide out. If Europe, which is a market of 300 million wealthy consumers, are going to keep buying, 1,000, 1,200 euro iPhones, if they go into a downturn, the like of which I think we're going to see, right? I mean, I think all of these things just look overvalued. And what will give me the trigger is the price action, right? But I suspect it would take for this dollar really to back off and the Fed to really back off. You're probably looking at a euro at those low 80 lows, right?
Okay. So the major narrative I'm getting from you, Julian, as we wrap up is let's take a little more of a telescopic view, is that this bounce that we had this summer is terminating, and that this is the resumption of the bear market that should take out the June lows and continue till about 3,000 when the Fed starts getting concerned.
Yeah, I mean, look, I use some simple little metrics, simple moving averages.
Simple is powerful to me, bro.
It is, mate. Yeah, it is. It is absolutely. Yeah. And those crossed in April, and I got a sell signal, and on the S&P, and I went with it. And then, I covered a bunch of stuff back in early summer. Yeah. And I said, typically you can move back up to those moving averages, and we did. We came right back up to, some of my moving averages, and so
200-day capped it.
Two weeks ago, we slotted a bunch of, we bought downside puts for November and December at 3,800, and we slotted the S&P, and that to me just seems like the cleanest trade out there. I mean, right here, right now. I think it'll come down to QT, right? I mean, the Fed has not done as much QT as they suggested they would, in part because they've had problems with the mortgage portfolio. I thought it was interesting yesterday that Bostic talked about how they may have to hit the bid in mortgages, that they can't just rely on, prepayments, which obviously aren't happening at the moment, given where rates are, causing the balance sheet to run off, that they may actually have to start hitting the bid. And I think, 3,900 is what my liquidity model suggests is kind of currently fair value for the S&P. But as we know, next month, QT doubles, right? So
are you okay? So are you bearish enough the housing market to sell your house?
I have no. I'm keeping that one. It carries kind of well, so I'm keeping that one, Dale.
Okay.
And
your rental properties.
Yeah, I mean, I would be. What I'm looking for really is not an 08 style bust. What I'm looking for is a collapse in housing construction. Okay, so the sort of thing that you saw in early 70s, early 80s, early 90s, where sort of new home building goes from like 2 million to 1 million. Okay.
Okay. Yeah.
And that's enough to give you typically a pretty nasty recession on its own. Add in a very ugly inventory cycle, which I talked about, you're already seeing in Europe. I think you're going to see a recession. Are we there yet? Absolutely not. Does the Fed have to probably keep doing more? Almost certainly. And that's why I think we're still in this sell risk rallies and wait for something to break, right? And the dollar is typically the wrecking ball. It's the napalm in the napalm run, right? It's a risk off dollar rally I refer to it as a napalm run.
I love the smell of napalm in the morning.
Correct.
It reminds me of victory.
True. Well, in this case, yeah, if you're short. But that's the reality, right? I mean, a risk off dollar rally is the real killer, because most assets are denominated in dollars, so they're falling anyway because you're in a risk off environment, and then the denominator is rising, and so you're turbocharging the decline, right? It's really, really vicious, and left to its own devices, all you're left with is a bunch of smoking holes and charred bodies, right? And so that's when you look to take advantage, but we aren't there yet. No. I mean, there's no signs of capitulation in this equity market. Why? How can you capitulate and put the low in with the VIX in the 20s, for Christ's sake, right?
Yeah, I mean, this whole cycle, we never got above 40.
No, not even close.
We really never had it. It was almost orderly, the decline, instead of chaotic, right?
Yeah, and I think that was because, and I think we saw the consequences of that. I was looking at it back in early summer, and it was amazing me. I mean, long short equity or equity hedge funds generally don't outperform the market, right? Particularly in a down market, right? They actually underperform because these guys are usually balls to the wall long, right? And leveraged. For the first time in God knows how many years, they actually outperformed. Right, they actually outperformed, which told me that the pros had hedged successfully into the first leg of the downturn. We then get the squeeze as a result of them hedging, and retail or high net worth hadn't sold at all. Not at all. Not at all. So there's no capitulation in my mind.
Okay, so Julian, what a great day to have you, as Blake said, with the NFP, and I root for you. I'm a fan, and
thank you, sir.
And here's where people can find you and your excellent elite analysis. And I didn't interrupt you as much as I usually interrupt people, because I learned from you today, and I really appreciate you coming here to edify our community, and hope that all of your trading objectives are accomplished.
Well, let's hope so, Dale. Yes, that's what we have to. That's what we have to listen to, and hope for. And look, if anyone wants to follow me at JulianMI2 on Twitter, is probably a good way. And then just ping if you are interested in subscribing either to the institutional stuff or to the macro insider stuff that I do for the retail guys. Just ping us on the website, and we'll get back to you. Thank you very much.
All right. Thank you for the clarity, my trading warrior brother. Appreciate it.
Pleasure, sir.
All right. That Julian Brigden, everybody. Follow him. Check him out. And have a great weekend, everyone. Could join the team in 15 minutes for the morning edge. I'm calling it a day. Good hunting the rest of the day. And most of all, everyone, don't just count your pips, count your blessings. You're hearing about people that can't pay their utility bill. And here you are gambling and speculating. Acknowledge that you're in a better position than a lot of people in the world to assume risk when they're trying to balance a decision between food, electricity, and medicine. And that's all I have to say. Have a great weekend, everyone. Thanks again, Julian.